Hello and welcome to the latest Hardman Talks. I'm Brian Moretta, investment analyst and host of the EIS Navigator podcast. Today we are joined by the CEO, Steve Murray, and Finance Director, Dave Rimmington of Chesnara. So we're going to talk about Chesnara, learn a little bit more about it, and try and cover the strategy and what's happening. So welcome. It's very good to have you here.
Thanks, Brian.
So we'll start with you, Steve. Can you maybe tell us a little bit about what Chesnara is and give us sort of a very high-level overview for people who haven't heard of it?
Yep, absolutely. So Chesnara is an insurance company. That's what we do every day of the week. We're based in 3 territories across Europe. So we're based in the UK, here in Preston, in the north of England. We're also based in the Netherlands and in Sweden as well. And we do 2 things. We either run closed books of insurance, so businesses that no longer accept new business. So we do that both in the UK and in the Netherlands as well. And we also have 2 business lines that are taking in new business. What we do in terms of those new business areas is predominantly term insurance in the Netherlands with some pensions as well. And in Sweden, it's the opposite way round, where we're doing pensions business with some other bits and pieces. We've been in operation for almost 20 years now. We have an unbroken track record of paying dividends and increasing our dividend every single year over the last 17 years. And that's probably a good summary, Brian.
Excellent. And for people, what will probably help people also is you have 3 strategic aims. So it's probably worth outlining those because those are something that were important for the context of the rest of the discussion.
Yeah, so we do 3 things. So firstly, we're looking at maximizing the value that we create from those insurance businesses that we have. So running customer assets as effectively as we can, looking for opportunities to drive operational synergies, and there's other areas of value that we can create from them as well. Secondly, we've got a rich history of delivering value through M&A. Actually, Chesnara started, its entire purpose was as a consolidation vehicle. So we've got a rich track record of delivering acquisitions, and that's certainly a big area of focus for us going forward. And thirdly, we generate commercial value through new business as well.
Excellent. And you mentioned about dividends. I think a lot of investors hold this for the income. What's your sort of strategy around the dividend?
Yeah, so again, if you look at what we've done historically, we've got an almost unmatched track record in the insurance sector of paying an increased dividend every year for the last 17 years. We're looking at ways that we can continue that dividend growth going forward, and that's a core part of our dividend strategy.
Excellent. So we'll come back to that. For the moment, let's turn to the first of those, which is really about running this book. So Dave, can you tell us a little bit about how you actually make money from running a life insurance company?
Yes, and if I may, I might just start by talking a little bit about the financial dynamics of a life company, because it probably helps put what we do into context. So we operate to a statutory regime called the Solvency II regulations. And what they effectively do for a life company, you value the company, and it's a metric called own funds, and you have to carry a certain amount of capital called the statutory capital requirement. And our job is to maximize the difference between those 2 numbers. So we maximize the value of the company whilst minimizing the capital we need to hold. And that difference is called surplus, and it's that surplus which is ultimately available to distribute to firstly the parent company and then ultimately on to shareholders. So how do we increase the value of the company? Well, we hopefully over time get investment returns better than risk-free, especially on the equities the customers hold.
So it's worth saying that in Solvency II, the profits is all about the comparison with what actually happens versus what happens in the assumptions.
Indeed, and interestingly, the valuation assumes risk-free returns.
Yeah.
So everything else being equal over time, you would clearly expect asset growth better than risk-free. So that creates a source of future income, which increases own funds, therefore increases the surplus. We also add value through new business, and we'll come on to that. And also we have operating assumptions, be they expenses or mortality. And again, as you suggest, if we can exceed or perform better than the assumptions, we get an uplift in value. So there are all the things we can do to increase the value of the company. M&As, of course, add value, and we'll talk about that again later. But reducing the capital requirement also creates capacity to pay the dividend. And what we do there, we can undertake management actions, like we can hedge portfolios, we can optimize the assets we hold so that they're not as capital intensive. We can reinsure the business. There's all sorts of actions available to minimise that capital requirement, and ultimately maximising the difference between those two numbers is what we do day to day on the in-force portfolio. Ultimately, first and foremost, whilst making sure the policyholders get the most appropriate returns.
Yeah. So there's always that balance between serving the shareholders, but also treating policyholders fair,
Yeah,
and fair,
absolutely.
giving them their expectations. So one of the key measures you use is economic value. So how does that fit in with what you've talked about?
Yeah. So own funds is defined by Solvency II rules. And there's a couple of areas where we, along with the rest of the industry, to be honest, think it probably undervalues a company in pure commercial terms. The most obvious thing is it includes a risk margin. So it requires us to hold a level of margin against risk. It's quite an onerous amount, and it suppresses the own funds. So in our economic value, effectively we add back a proportion of that kind of prudence. Also, there's real technical things like something called contract boundaries, which for certain contracts means you can't recognise future profit expectations in your own funds, but of course commercially you do expect those future profits. So there's a couple of well-documented adjustments we made which move from own funds to economic value. But economic value in essence is the net assets of the company plus all the future profits we expect to make from the in-force portfolio.
So effectively it's a discounted cash flow.
It's a big discounted cash flow. Importantly, it doesn't include any value for new business profits, so they come through as they rise, and it doesn't, of course, bake in any potential for M&A.
No, which is obviously going to be uncertain by its very nature. So you mentioned about the things you can do to optimise the running life, but do you want to tell us about one or two of the things you've maybe done in the last few years to improve how the company's run? Yeah,
so we've focused quite heavily on the capital side of that equation, kind of reducing the capital we need to hold. I mean, clearly, reinsurance is a smart way to reduce risk, but to some extent you do give away value. So we've historically not overly reinsured, but over the last few years we've been a bit smarter with our reinsurance. Recently, earlier this year, we took out some extra catastrophe risk reinsurance in Skilden, our Dutch business, and that creates a really big lift in the surplus because it reduces the risk we're exposed to. We also are constantly looking at ways to invest our assets in a way which gets the maximum return, but with a minimum level of Solvency II capital. So, for example, in the Netherlands, we moved some of our BBB corporate bonds, so a relatively secure investment, but they still have a relatively high tariff in capital terms. And we've reinvested them in a mortgage portfolio, which is quite extensively used in the Netherlands, which is deemed to be probably even lower risk, but even less capital. But you still get a decent return. So there's all these actions about reinsurance. The one we've not done a huge amount of to date is hedging, but we're very confident that's a management action we've got up our sleeve if ever we need to, under stress conditions, increase that solvency, that surplus level so we can continue to pay the dividend. So sometimes it's as much about the actions we haven't taken, which we've got available, as it is about the ones we have taken.
Yeah. And it's probably worth talking a little bit about some of the operations individually, because there's some interesting dynamics of some of these. So I think a lot of people will probably, who maybe known Chesnara for a while, will think of you as a UK operation, which was initially where you started, but it's not even now the largest part of it. But the operation is basically closed books that are run off. So how do you manage those and optimise the value within those books?
The closed books in particular?
Yes. It's the UK.
In the UK, well, it's probably the things I've talked about really. Good customer service as well. The portfolios are relatively stable actually, so we are exposed to policyholders leaving the business, but actually we assume a certain level of persistency and lapses. So as long as the experience is better than we assume, but of course, the better you look after the customers, the less likelihood it is to trigger a lapse or policyholder leaving. So good customer service is really important, even though you don't necessarily see a direct financial benefit from it. But again, it's about making sure we get smart investment returns, the capital management actions in both the closed book in the UK and VARD, which is the small closed book operation in the Netherlands. Yeah.
And thinking about the more dynamic books, so both Sweden and Netherlands have had interesting things going on. Do you want to talk a little bit about the Swedish market and and how you've been dealing with some of the changes there.
Yeah, so we've had a really interesting journey in Sweden. We bought Movestic over a decade ago now, and it's grown quite. We've managed it as a growth business, open to new business. Mm-hmm. It's grown to be significantly more than 3 billion of assets under management, and along that way, it's become cash generative to the group, which is really useful as an income stock. Mm-hmm. But it's like in all territories, there's always operational challenges, and one of the features we've seen over the last couple of years is challenges on the levels of business transfers going out of the portfolio. We've had many years where the balance of ins and outs has been positive. Mm-hmm. We've had a couple of years where it's switched the other way. Yeah. We're very confident that it's due to a couple of things. COVID has driven some different behaviour, no doubt about it. But also there's been some quite aggressive competitor pricing, which we know is not sustainable. We know that offer is going to end shortly. So we very much expect that balance between transfers in and transfers out to resume to kind of neutral at first and then back to being an hour to a positive to us. Yeah.
What role do you think the legislative changes have taken?
To date, they've acted as a bit of a headwind. But we do know that there are changes to come regarding transfers. So there's still a large proportion of the Swedish market which isn't open to transfers. So whilst we've been exposed to that risk, there's a more traditional part of the market which hasn't had that risk. We know in 2022 the legislation changes are going to open up that market. So for us, we see that as a large positive because that's a new source of business we can actually, for our new business operation, we can look for transfers from that business. And we suspect that more traditional market might not be quite so competitively priced to the policyholder. So I think today transfers has been a tough journey, but we expect it actually to be good for us in the future.
And you focused a little bit more, I think, on custody funds recently. What effects that had in terms of volumes and margins?
It's been really good on volumes, and I think with the core broker market being a bit quieter during COVID time, which is that level of activity isn't there, it's been a really good kind of string to our bow to be able to go and get some of this, what is very high volume custody business. So it's been great to kind of the top line APE, but it's slightly lower margin than the core broker business we write, the core pension business. But with the volumes we've been achieving, it's been a fantastic outcome for the year. And very much now expected to be a core part of our new business strategy going forward.
And given what we've spoken about, some of the lapses rising in the other part of the book, if you've got this from moving, is there any sense that this is hot money, or is this going to be stable funds?
I think there's always a risk of an element of churn in the market, but it's definitely been a unique period where the money's been a bit hotter than it would normally be. So we're very confident it's a temporary issue, and ultimately we're confident that it will work to our advantage eventually.
And are there signs of the competitive position easing already?
Absolutely, yeah. They've reduced their offer already. And
there's one competitor in particular?
Well, it's only been one competitor actually. It's been a mutual who's just really, I think, seen the opportunity to take advantage of the market and are really priced aggressively. But it's not sustainable, and clearly it's not, because they're taking that offer out. So us, along with others, have had a bit of pain from that, but we've come through it pretty well. The economic value of Movestic has actually continued to grow during this period. So this has been an operational challenge, but it's not done any kind of permanent, non-recoverable impact to the business.
So mortality has obviously been a hot topic in recent times with COVID. You are net long mortality, so you're net exposed to mortality. You spoke a lot about term assurance. What effect has COVID had on your experience over the last couple of years?
Yeah, the business has coped fantastically well, and our people have done a brilliant job keeping the operation going. In the UK, we're largely outsourced, so working with our outsourced providers, we didn't really miss a beat in terms of keeping that service going. The IT capability we have here is run remotely, so we're able to have everybody working from home, and actually we'd adopted hybrid working many years ago, so this wasn't kind of a new experience for us. And we've seen that similarly both in Sweden and across the Netherlands as well, where we were able to enable people working remotely very quickly. So if you kind of had a good COVID, we feel like we have kind of operationally, and we've continued to deliver against the promises that our customers needed us to deliver against for them. We haven't really returned fully to the office, so we've been bringing people down and back in the office slowly and gently, just to kind of get people used to coming back in. So we're continuing to work at the moment in a hybrid way, and we're finding that working very, very effectively still for us. So.
And I see, reading the past annual reports, you've spent a lot of time and money working on the IT infrastructure in various ways. Do you want to maybe talk a little bit about that and what effect it's had on the business?
Sure. I'll maybe start, and Dave, you can add. So some of the investment that we've been making is in the systems to support new business, particularly within the Dutch market. So we saw an opportunity in that market to transform our systems and make ourselves easier to deal with, particularly the digital front ends, enabling both customers and brokers to deal with us in an easier way than they had historically. So that's where a large part of that spend has been made, transforming some of the pension systems that we had that were supporting that skilled in business. And we've also put some investment into the infrastructure that we've had to make that a little bit more scalable as well. And we've seen the benefit of some of that during COVID, as we've just talked about.
Yeah, and I think a similar journey in Movestic really. It's tended to focus has been probably on the areas which are open to new business because it is that customer front end. Our back office systems on the closed books are all pretty robust and solid anyway. So so similar journey in both as we described in Skilled, but the same in Movestic.
And thinking about Skilled in particular, and sticking to the COVID theme, there's been some additional mortality reserve in the Netherlands in the past sort of 2 or 3 years. Do you want to maybe just talk a little bit about what's the driving force behind those? Because there seems to be a slight disconnect between what the regulator's expecting and what you're actually doing.
Yeah. In simple terms, in the Netherlands, it's deemed to be kind of best practice to adopt mortality tables which are produced centrally.
Yeah.
So it's not a mandatory requirement, but it's seen as like the most readily kind of expected mortality assumption setting. So we adopt central tables. We happen to believe the mortality experience of our actual customer base is slightly different from those mortality tables. So we would expect, on balance, for there to be kind of modest mortality related profits coming through in the future. It's not a big issue; it's a relatively technical issue, but we feel we're on the right side of that mortality expectation.
And the additional provisioning, what was the drive behind that?
Well, it was those central tables actually assumed a lower rate of mortality improvement going forward in more recent ones than they did in the past. Okay,
so they were in some sense, so they're assuming lower mortality.
No, they were assuming higher mortality.
Higher mortality.
Yeah.
Right.
Yeah. Exactly.
Okay, well, let's get the right around. So we touched on new business a moment ago. There's been some real dramatic changes over the last sort of 18 months. Do you want to maybe talk about what's happened in each of the countries and what's your sort of expectations going forward?
Yeah, so as Steve said, we're open to new business in one of our Dutch businesses, so Skilden in the Netherlands and Movestic in Sweden. We sell relatively straightforward products. It's primarily term assurance in Skilden, although we do see a market for DC pensions growing. And in Sweden, it's predominantly simple customer DC company DC pension schemes. So we try to keep new business proposition relatively straightforward because we don't want it to distract, and it's quite important we don't want it to distract from the primary objective, which is kind of making value from the existing customers and M&A. So, but it's a really helpful third component to our objectives because it does two things. It does create value in its own right, and we have a medium-term objective and expectation that we will cover about 50% of our annual dividend through incremental value from new business. So it funds part of the dividend. But also it's important because what it does maintain the scale of the operations in those open businesses, which means some of the challenges you face in a closed book about scale runoff, you just don't experience in half of our operations. So it helps the operating model whilst also creating some profits.
Yeah, and am I right in thinking that you perhaps had improving unit cost as a consequence of that?
Yes, in particular in the open businesses,
Yeah.
that's true. And interestingly, across the whole of the Chesnara group, on balance, we are a growing group. Because people might be, for a company which is probably perceived as being a closed book consolidator, there's probably a perception that we're a shrinking group, but actually in terms of both assets under management and policies, in 2020 the group did increase in size.
Excellent. So focusing still on new business, in the last 18 months there have been some effects from COVID on the market as a whole, and that's had an effect on your business. And also in Sweden, we spoke a moment ago about some of the changes going in the market. How has new business behaved over the last sort of 18 months?
Yeah, I would say it's the one part of our operational model which has been most impacted by COVID. We've definitely seen a marked reduction in volumes of our core pension business in Movestic, and there was a slight lag, but ultimately then the term business in Skilden also started to reduce. And I think it wasn't on people's radars. Companies weren't in the office, people weren't thinking about their long-term pension arrangements, and brokers weren't as active. So we've definitely experienced a bit of a dip in our new business volumes, which you can see in the new business profits. The first half of 2021, they were positive, but not where we expect them to be in the medium term. So our expectation is 2022, they'll be, depending obviously what happens with COVID in general, but assuming matters improve, we would expect the new business profits to start to pick up, but probably more 2023 before we get to where we were before COVID.
And that's the same in both Sweden and
Netherlands? Similar profiles, yeah.
Excellent. And how do you think about new business strategically in terms of what's you've got these effectively two profitable business lines. I know there's various other bits and pieces. Are you happy with those? Do you want to grow market share? Do you want to expand business lines? How do you think about these?
So I think as Dave talked about, it's very important that we can show that whatever we do as a business, that can add to the overall cash flows that we have as a group. So I think provided that we can see the outlook for that continue, we're happy to write new business in a kind of focused way in those territories. We do see opportunities, as Dave has also talked about, to grow share of either some of the markets that we're in or potentially move into other areas. So we talked about the custodian business within Sweden. That's a nice add-on for us in that market. We like the kind of profit dynamics of that as well. It's relatively low capitally intensive, so the payback of that business line is pretty good for us as well. That said, and again, Dave I think was quite clear about this, that the focus of Chesnara as a group is absolutely on running the books of business we have as effectively as possible, and then scaling those up further through M&A. So I'd still see the lion's share of the activity that we undertake going forward being in those areas.
Okay, which nicely brings me on to the next topic, which is sort of your acquisition strategy. In the recent note we did, I had a page devoted to the acquisitions that Chesnara has done over the years. What is your acquisition strategy?
So our acquisition strategy really is to make sure that we're as an attractive counterparty as we can be for companies across Europe. Our focus historically has been more on unit-linked businesses because we've seen the opportunity both to create some further unit cost efficiencies for us, but also beat investment return assumptions, so you can deliver assumptions above risk-free. Looking forward, I think we can be a little bit more flexible. I think there are a broader set of insurance books that can be attractive for us, particularly if you look at some of the diversification benefit that we can generate through them. We've been particularly successful looking at some smaller deals. So if you look at the Sanlam acquisition that we announced recently, and also the Robin Leven deal that we announced in the Netherlands, they were relatively small portfolios compared to perhaps some of the bigger deals that you might see more broadly in the market. So I think those still make a lot of sense for us, but we believe that there are opportunities for us to extend the footprint of deals and maybe do some things that are more material.
Okay. Can you maybe talk about, you mentioned Sanlam and Robin Leven.
Yep.
I'm going to get it right. Can you maybe talk about those deals in a little bit more detail and particularly how they exemplify? I think these are typical deals for you in a lot of ways. So what characteristics of these exemplify what you're trying to do?
Yeah, and there are some there are some differences, I think, between the two that are worth us bringing out. So if we maybe start with the Sanlam deal, not least because that's a little bit bigger. We saw the opportunity there to bring further scale to our UK business, which is closed and in runoff. So it brings a large number of assets relatively to us for our business, so further circa 3 billion. We can manage those on our outsourced platform. So longer term, we should have a greater degree of certainty about the unit cost assumptions that we're looking there. And there's also opportunities for us to generate some investment upside, but also use some of the management actions that Dave talked about earlier, such as reinsurance and potentially driving some other operational synergies as well. But in large part, that business is a unit-linked kind of business. So we're looking at those three areas of value. When you
look at you mentioned about economies of scale. So was this basically a subscale business for its old owners? Can you make it more efficient?
I think it was, and I think there are some opportunities for us to make it more efficient. But also, I think it's important to consider the longer term assumptions that you have to make around these books as well. So I think what we can also do is bring a greater level of certainty to those longer term unit cost assumptions, perhaps than Sanlam might have been able to do on their own with both the scale that we have, but that outsourced partner model that we run in the UK as well.
Okay. And Sanlam, interestingly, was open to new business, or is open to new business. You're not open to new business in the UK. How did you view that new business?
Yeah, we view it through the same lens that we view the new business that we write. So we look at the commercial economics of that, the long-term prospects, and evaluate whether the right thing to do or not is to continue to write that new business going forward. So I think when we look at Sanlam, we see lots of opportunities to manage that in-force book more effectively going forward. But I don't think we see that drastically changing that overall UK strategy, which is in very large part just continue to run closed book effectively. We do also accept increments. So while we say we're closed to new business, we do actually see quite a lot of top-up activity, particularly going through with the unit-linked pension books and things like that. So
And thinking about Robin Laven?
Yeah, so in a different part of the market, clearly, and a different set of products, but we were able to buy that portfolio at a discount to embedded value. That was similar to Sanlam. We're able to drive some unit cost synergies, but we also see some opportunities to create, hopefully, some further value going forward on the investment side as well. The difference there is within VARD, we run our own internal systems and platforms. So Lawrence and the team based out in VARD will be working with the team at Robin Laven to work out kind of what the most effective way of running those portfolios are going forward. But we certainly expect ourselves to be able to create further value going forward from that acquisition as well.
And VARD is a operation you bought about 6 years ago, which was in essence is a closed book and as a platform for future consolidation. Is that right?
Yes, and we've done a number of kind of smaller portfolio deals there that I think have worked very well for us, and we've been able to drive a good amount of value and ultimately cash flow back to the group kind of from those portfolio deals.
So we've seen some changes in the market over recent years in terms of, I think the feeling is it's become harder to do acquisitions and transactions in that there's more competition out there. Though curiously, I see it was a reinsurer who I pegged as a consolidator that was selling Robin Laven to you. So I'm not really sure what's going on there. How are you seeing competition, how it affects your ability to find transactions, and I think probably of concern to a lot of people is the potential effect on pricing?
So I suppose we believe that a competitive market is overall helpful. Because I think if you're thinking about selling an insurance portfolio or an insurance business, knowing that you have a number of potential options out there is quite helpful. So I think overall we'd see more things coming to the market where there's a buoyant kind of M&A market, and we've certainly seen that over the last 18 months. In terms of where we see that competition, I think you're seeing it particularly for some of those larger deals. That's where some of the bigger consolidators are focused. That's where you're seeing quite a lot of the relatively new private equity money that's coming into the market operate. So for us, we probably see parts of the market that are slightly less competitive where we continue to thrive. And certainly those deals that are below the kind of $1 billion mark or the $500 million mark, I think we're seeing slightly less competition for those than you certainly would for the bigger transactions in the market.
Yeah, and you feel you have, I mean, you have resources, but they're limited resources available. Where do you feel your resources available for transactions are at the moment?
So I think we're in a really good place. So we've got a team that's got experience of doing M&A, and our shareholders, the vast majority of them bought into Chesnara because they believed that there were opportunities to create value from consolidation. So they're kind of well used to us speaking to them about M&A and are kind of well educated in how the market works. If we look at our ability to finance deals, so we have capacity on the balance sheet. One of the things that Dave and the team did relatively recently was put in place a kind of small RCF that we're able to draw down on for the Sanlam deal, and we still have capacity available there. And for bigger things, ultimately, we could speak to our shareholders, and there might be partnering opportunities as well for us in the market. So we think actually overall, we're well resourced. We're trying to make sure that we're in the best possible position to take advantage of some of the deals that are coming to the market.
You mentioned earlier about the effect that the way you look at deals is evolving. Can you maybe talk about evolution in your criteria and what you're sort of looking for in terms of because everything you've bought so far has been at a discount to your economic value or embedded value, and there's a feeling that might not be sustainable in the future.
So I think Dave talked about some of the components of value that aren't recognised within more traditional insurance metrics. So I think we're very much aware, and what we've been doing over the last months and years is updating our criteria to make sure we have as clear a view as possible about what the totality of the value available is from some of these books of assets. So I think that's one of the bigger changes that we've made, and we've certainly, our board are very much aware of where some of those sources of value are. So thinking about that risk margin, thinking about the ability to generate returns above risk-free, and then some of those other value levers that we have available. So I think there's a level of sophistication that the team have kind of built up over time, which allows us therefore to look at the totality of those value pools available, and should mean that we're able to price competitively, but at the same time still maintaining our discipline and making sure that the deals that we're doing create great value for our shareholders.
And in terms of geography, is it a case of certainly we look at the UK and the Netherlands as being the two closed books which are consolidators.
Sure.
Would you look at something in Sweden? Would you look at something in another geography as well?
I think we would. I think it makes sense for us to certainly look at opportunities in our core markets, because we have the operating infrastructure, we have the networks available, we have the actuarial capability within those markets. But we're certainly open to looking at deals more broadly across the businesses that we already have in place, but in other markets as well, again, through that lens of making sure we're really disciplined about the approach that we take to generating shareholder value. And I think we've got a good track record over the last few years of delivering value from these things. So we should be open-minded about those other opportunities, in my view.
And would there be a case for paying a fair price for a platform in another country on the basis of, well, once we've got this platform, there's plenty of other transactions to do? Or are you looking at every transaction more on a standalone basis?
I think you have to look at things, you absolutely have to look at things on a standalone basis, but we're not ignorant to that kind of strategic lens that we should be placing on things as well. So, and we'll look at these things on a case by case, but if we looked at a new opportunity and felt that would allow us to do further deals off the back of that and create great value for our shareholders, we'd absolutely look at that.
So thinking about the finances, so I'm going to look at you again, Dave. You mentioned a bit about how sort of you work at Solvency II at a high level. How do you actually generate the cash? Because obviously if you're paying a dividend, you've got to generate cash. What is cash generation in Chesnara?
Well, we define cash as being, or cash generation as being the movement in the Solvency II surplus.
Yeah.
So it's not cash in the sense the man in the street would see kind of pound notes. But what it did, it's basically a financial amount which, subject to some secondary barriers, you can distribute. So real cash in terms of liquid resource, we have about 55 million in our balance sheet as well. So what we've got is a business which is generating surplus, which enables you to pay dividends. And those dividends ultimately at the parent company then sit in the form of real cash. And we've got healthy cash reserves and a clear line of sight to future surplus generation. Because surplus, as you say, evolves from the in-force book as fees from policyholders and fees from the premium design create value, and then that flows up to the parent company.
Yeah. And presumably you've got a fairly steady cash flow expectation in terms of policies maturing and
there's a certain level of predictability. You know, of course things can vary, but our track record has proven, if you look at the absolute level of surplus Chesnara has operated at over the last 5 years, for example, and it's been a hugely volatile time in the world, with markets in particular being volatile. The level of solvency post-dividend, so after we've paid for a dividend each year, is remarkably stable. And it's that stability of our solvency model which has been the cornerstone of our dividend strategy.
So why is the cash more stable than profits?
Because there's a natural hedge. It's quite complicated to explain, but so while the value of the company might move, so if markets are in a dip, equity markets, for example, the value of the company would fall, which would create kind of a loss from a profit point of view. But at the same time, the capital requirement we need to hold drops as well. So there's a natural symmetry between the two. So in flat markets, capital requirements drop, so you maintain that same level of surplus. So you've got this really healthy, stable surplus, even when the absolute value of the two components is moving up and down. And it's perfect for an income stock.
So it's naturally counter-cyclical.
Yeah, exactly.
The way the capital is addressed. And internally, there's been a change in dynamic because the UK was really the source of the dividend up until 3-4 years ago. But within that, there's been sort of a growing, I was going to say dependence, but growing usage of capital or the ability from the other operations to generate cash. Do you want to maybe talk about that change in dynamic?
Yeah, I think it's important to note that as things stand, the UK closed book remains the core source of cash. But it's really important that, as I think I mentioned earlier, in the Swedish business about 5 years ago, it reached a scale, and this was an interesting concept of scale. Once you get to a certain scale in an open business, it does in its own right become cash generative. So really helpfully, Movestic started paying dividends about 5 years ago, and it's not going to be this source of cash you get from a closed book where you get the SCR runoff, but it's a really positive contribution to the group dividend model. And similarly, adding the Dutch operations, VARD just strengthens the closed book component. So VARD, we always describe, it's relatively small, but it really punches above its weight in terms of the amount of dividend it's paid to the group. So you've got two closed books operating now. Movestic has become cash generative, and we've had some volatility in Skilden's cash generation, but the cumulative net position is positive, and we expect it to be positive going forward. So I'd say what you've got is the closed books remain the core of your cash, but the open businesses are making healthy contributions. And as they grow, there should be a natural shift towards their capability to fund dividends. And
how much visibility do you really have? Because this is something people, I think get a little bit almost skeptical about, because they're not used to companies having confidence in their ability to generate cash.
Yeah, well, I suppose our portfolio is just a series of long-term contracts with individuals. So unless something completely untoward happens, there's, on average, you expect those policies to be there for a period of time, and the fee structures are relatively set, and our cost base is well defined and not subject to some of the variability you might get in other businesses like fuel or other external factors. So your cost base is very predictable, your income streams are very predictable, the capital framework is very predictable, so everything else that all adds this level of certainty and clarity of sight to future cash.
So looking at the cash flow and the dividend, you've got some visibility in what's going on. Obviously there's UK life books, which, well, not just UK, but the closed books, people have got a natural concern that it runs off and sort of fades away. And you've already got the new business and the acquisitions that will sort of counter that they're a little bit uncertain in their nature. Obviously, we don't know when acquisitions are going to be. We've seen that some uncertainties about new business in the last year or two. How much visibility do you really have into sort of the cash flows and the ability to sustain the dividend?
Yes, I guess it's difficult to answer this without giving away non-market information, but I suppose as a useful proxy, the economic value of the company, which we talked about earlier, is effectively the total cumulative cash you expect to come from it.
Yeah.
Okay, it will take a long time. So that suggests the ultimate cash flow from our existing portfolio is circa 620 million. Because over time, when the SCR runs off to zero, that will all become available for distribution. So it just gives an indication of how much latent cash potential there is in the portfolio. It's a big number. The speed at which that comes off depends on how quickly the SCR runs off. And of course, that economic value of 620 million doesn't include the positive impact of real world investment returns.
Yeah.
So there's a big number.
Which I estimate as a big part of the
and
profits.
You put in your note a number for that. So I think it's just fair to say the cash isn't running out anytime soon. It's probably the best way I can answer it.
I think, Brian, one of the other things we've had is, so we obviously have a series of contracts with individuals going forward. You make assumptions around those. And what we've seen over the last few years is some pretty volatile conditions to kind of assess the stability of those contracts and how the cash comes through. If you think about COVID as an example that we've already talked about, think about the market crashes that we've seen kind of recently. And what you've seen from the insurance assets and the policies that we manage is they've remained very, very stable, which again gives us a larger degree of confidence in the assumptions that we make around those books of business. So.
Yeah. And the obvious question to follow on that is, assuming, having got confidence about non-decline of the dividend, rate of growth and how do we grow it? Is this a case of you need to keep doing more deals? Do we need the M&A to happen quickly?
So I think M&A clearly is helpful for the long-term sustainability of the dividend, assuming that we can find the right opportunities to create value. But in the short or even the medium term, we're not reliant on M&A to support a progressive dividend policy. And Dave also talked earlier on about that medium-term objective of ensuring that the new business that we write and the commercial value of that provides some dividend coverage as well. So we like the three strands of the strategy. We think they work very, very well together, but we don't need all of them to be firing on all cylinders at all time to support that dividend. So we can be quite patient if we need to be about things like M&A coming through.
Okay.
And interesting, just in terms of the deals we've recently done, which we've said are relatively small compared to where our ambitions might be, but we reported in the announcements for those acquisitions that they're going to generate circa £7 million a year of steady state extra cash. And that represents about 20% of the total dividend of the company. So two small deals can make a pretty serious positive contribution to that ongoing cash story. So there's always things happening which are meaning that the rate at which that cash continues to flow is enhanced.
So yes, you could easily do a back of the envelope calculation. If you spent all the resources you had available on deals, you could get significantly more cash flow coming in.
Yeah, sometimes it takes a bit of time. Sometimes you can go through a period of short-term strain, depending on how you've financed a deal. But one of our criteria is to make sure we understand when that cash becomes positive. As I say, small deals can make a meaningful difference.
So in terms of new deals coming in, you would look for companies that can generate cash relatively quickly. You wouldn't do something in 10 years' time that's going to start generating
We
cash.
wouldn't do a deal which compromised the dividend strategy.
Right.
I think it's the best way of putting it.
Right. So you see, so there might be something that maybe doesn't enhance the cash flow immediately, but would have longer term benefits. So fair enough. So, Steve, you are relatively new to Chesnara.
I am.
You have been in the CEO seat for less than a month.
That's right. Since my regulatory approvals came through,
I thought it might be interesting to ask you, why did you join Chesnara?
I saw just an organisation that I felt there was lots of potential there and lots of interesting opportunities for us to look at the way that we create value going forward. And we've talked about quite a few of them during the session already. So I like the fact that we had international diversification. We've got positions in multiple territories, which mean that, if the UK market isn't performing quite as well, that may mean that the Dutch market or the Swedish market is. So, and we've got different choices to make in those markets and different levers that we can pull. The fact that we do both closed and new business, again, for me was interesting. Again, there might be different ways that we can create value. And particularly given my background, the fact that it was an organisation that was accustomed to thinking about M&A and doing M&A, a number of the shareholders have been with us for a long, long time, want us actually to go forward and look at value creating M&A opportunities, again, for me was quite interesting. And when I just looked at that all together, I just thought, what a great opportunity to work with a great company, a good set of people, and see where we can take the business kind of going forward. So there wasn't a huge amount of hesitation when I got the opportunity to kind of come here, and I've had a great time so far, and I'm looking forward to the opportunities I have in front of us.
So, having got comfortable with the actual cash flow, what do you see as the main attractions of Chesnara for investors as a stock?
Yeah, so we've talked earlier about the dividend track record, which is clearly impressive. And to note that during that period, the yield it was offering as well was back between 6 and 8%. So it's a high yielding investment with a huge level of predictability historically. And we've talked about the level of confidence that continuing in the future. So, and also, although we are primarily an income stock and that yield is our kind of main investment case, there's been a significant level of economic value growth over that same period. The economic value has grown from about 100 million on outset to over 620 million now. So we're not an income stock. So we are an income stock, but we've also offered some growth. So you get a combination of no nonsense, relatively predictable high yield with a potential upside from equity growth as well as on when we do acquisitions. So it's that combination of the predictability, the value and the growth, which we think makes it a very good income stock.
Yeah, and certainly in our forecast, a prospective yield of over 8%, I think inherently brings attractions to a lot of people when you have comfort that that's got good growth prospects. And final word on future plans. How do you see the outlook and what you can do about it?
Yeah, so at the half year, we talked about renewed optimism for M&A, and that's continued. And when we did both the Sanlam acquisition announcement and the Robin Laven announcement, we reiterated that view that we believe there are good opportunities for us to look at going forward. And I think part of that is we're seeing international groups maybe look at their portfolios in a different way. We talked about the competition in the market, maybe encouraging some sellers that might have been hesitant now to come forward to the market and look at opportunities. And then we've put ourselves, we think, in a better position to kind of compete when these assets kind of come to the market. So on the M&A side, in terms of future plans, look, we're going to remain active there and certainly make sure that we're looking to grow the business through M&A. From a new business perspective, Dave earlier talked about the fact that we do see the market kind of slowly coming back post-COVID, and both through Skilled and through Movestic, we see some interesting opportunities to grow that commercial value and for that to contribute to the dividend. And there's still plenty of opportunities and levers available for us to manage those existing books even more effectively and look again at ways of us either accelerating the value coming through those books or optimizing the capital base. So in terms of what you should expect from Chesnara going forward, you should expect activity from us across those three strategic priorities, and we believe the future's bright for Chesnara.
Excellent. It all sounds very promising. So if anyone wants to read out more, we've recently done an initiation note, which you can get on our website. We'll post a link to the video. Otherwise, thank you very much, gentlemen, for your time today.
Thank you, Brian.
Cheers.